Hello and welcome to Value Research's special coverage of Union Budget 2025. Now, the Finance Minister unveiled a budget aimed at accelerating growth, boosting private investment, and supporting the middle class. But what does it mean for the markets and investors? To break it all down, we have with us Gaurav Misra. He's Head of Equity at Mirae Asset Investment Managers. Welcome, Gaurav.
Thank you.
Now, as we just said, the finance minister has presented a budget and, it has a strong focus on accelerating growth and private investment and also uplifting the middle class. So from a market perspective, do you see this budget as a game changer for economic growth, or is it more of a continuation of past policies?
No, I think the budget is very constructive from the outlook of the markets as well. But more importantly, from the underlying economic growth and the direction the economy should be taking. As we know, in the prior few years, there was clearly a huge increase in thrust towards government infrastructure-led growth. And in that sense, this budget is a change from that. It's a bit of a pivot where we have been seeing that consumption has been not growing as much, and therefore there is that additional spur to kind of promote consumption growth as well. Having said that, there's continuity with the past as well, because when we look at the breakup of government's expenditure profile into the budget for FY26, while overall expenditure growth is about 7.4%, but the much greater rate of growth has continued to be in the CapEx part of the budget, which is at over 10%, whereas revenue expenditure is within more like 6.7% of GDP in terms of percentages. So this, in a way, is a continuity of the past, where infrastructure within the expenditure has held the bigger weightage, and it's a good thing because it has the best multiplier effect, And I think we have seen in that sense continuation. This time around, the good thing, of course, of the budget is that there's this whole attempt to further fiscally consolidate, which has happened, from 4.8, we're going down to 4.4% deficit of GDP. And despite that, there is this additional spur to consumption. So yes, it's a bit of both a change, a bit of a pivot, a reset, and a continuation of the old approach of trying to have the most productive part of the expenditure take the forefront. So while, as I was saying earlier, that there are other parts of the revenue expenditure which are growing at much lower rates. So of course now, this is the attempt. We have to see how it works out. So when we saw the budget itself, the assumptions therein are fairly realistic. With the assumptions on nominal GDP growth and across on collections. One could argue that maybe on the private income tax collections, there's a slightly higher buoyancy which has been built in. But other than that, whether it's GST collection, direct tax collections, they're all very reasonable assumptions. And of course, I mean, there is a sort of tax sort of benefit. So maybe there is some elasticity we see. But given the environment we are in globally, so this whole attempt to be fiscally prudent and walk down that path, I think is welcome from the stability, not only of the macro, but even the market. The markets can be volatile, but this kind of budget, in a way, is very positive for investors who are looking at India with a slightly medium long-term view. The markets may be very volatile for a host of reasons over the next 1 month, over the next 3 months, so on. But this budget kind of is very positive for investments and for investors with the longer-term horizon. So yeah, that's how I'm thinking, about the budget. But in a way, as I was saying, if the quality of deficit has, been on that path of being qualitatively getting better year after year, and broadly, if inflation, etc., remains under control, then we can additionally hope to see some support from the monetary policy as well. So then together, when we think of this whole government, policies from both the fiscal and monetary side, it further sort of can support markets, corporate earnings, and all of that. And the last point I'll make here is that not only is this, are we talking about the next, 1 year, with reference to the budget, but in the budget there's also this elaboration of how the government wants their own government's debt levels as percentage of GDP to come down from what around the 57% levels right now to plus minus 50% by FY31. So over the next 5-6 years. Now that's again a good signal of macro stability and what it means in terms of the impact on macro parameters. So for instance, if in the last 3 years, as we can appreciate, that post-COVID, there was a need across the world by all governments to support the economies which had been shut for a while, and that had led to a huge jump in deficits. But if you think of it, in the prior 2 years, there's been a 160 basis point contraction of the deficits, fiscal deficits, and there is that contractionary impact which the economy has taken in its stride, and that continues this year. This year, we are seeing about a 40 basis point. But now when we look forward beyond FY26, what is coming out is that to reach to that 50% plus minus, central government debt to GDP would imply a much smaller contraction in the fiscal deficits from, the year after, from FY26 onwards. So therefore, this contractionary impulse will kind of now start getting smaller a year from now. In a way, when you keep all that in mind and you have a long-term horizon, things, and there's macro stability, the quality of budget deficits are good. As an investor, we just have to not feel too perturbed about short-term volatility.
Sir, the budget introduces some major structural reforms in the taxation, power, urban development, mining, financial, and regulations. Sir, which of these do you think will have the most immediate impact?
See, I would think that of all these, clearly the reform right now, or the the sort of support given on the direct taxation front, on the personal tax, should have the maximum effect at this point of time. It was a area of concern over the past many quarters, especially on the urban side, where I would think there's a greater share of the tax-paying cohorts which have got the benefit in this budget. So this 1 lakh crores of tax benefits which this whole cohort of taxpayers gets, would be 30 basis point to of GDP, which they get to kind of spend depending on what the marginal propensity to consume is, towards staples, discretionary, to save a bit, a combination of all of that. But I think it was much needed in that sense. I think that's where the better or the most multiplier effect will come, post this budget. We have to keep in mind that, where we are right now, by next year, the pay commission for the government employees, central government, and then spills over to the other, state government and so on, will also be at work. So that will provide another further, 20-30 basis point at least of GDP to support incomes and, the disposable incomes at household level. So I think that this trend which has started in this budget should, continue on the consumption side for at least a couple of years. And of course, we hope that, with that there is a multiplier effect, and you have, if the fiscal space is, and if the macro conditions stable, we can also have more, investments coming in from the private side, and we can see a virtuous cycle sort of pick up.
All right. Now, you were just mentioning the tax benefits. So the slab change aims to put more money in the hands of the middle class. So do you think this will meaningfully boost domestic consumption and corporate earnings, thereby benefiting equity investors?
No, that's an interesting question, because as a saying, that it will depend a bit on the propensity of the margin of the consumer, with the additional income, where would he be spending it, between staples, between discretionary items, and also maybe some into savings and investments. So I think it'll be spread out across. So if your question is, how it will benefit, I think there'll definitely be, this initial sort of support which consumption will get, no doubt. Maybe it'll be a bit more skewed towards discretionary, just given the income cohorts we're talking about, that 13 lakh and above and all of that. So that's one. But then we have to also think of it, in the second step, where if the monetary policies were also to get more supportive and accommodative, then that could be, a further support to clearly discretionary consumption, right? From real estate as well, in that sense, more an investment. But even that could get, the ability to kind of take more EMIs, or or more will get supported. So I think it'll be a combination. So as far as corporate earnings are concerned, uh, anything which adds growth and is productive and has a multiplier effect is going to be positive. But yes, it'll be a bit. I mean, I'm not saying it'll be top down; it'll be more bottom up. And there are other cycles at play also, which we have to be mindful about. There, in my view, there's a real estate cycle happening in the background. Might have gone a bit slow last 1 or 2 quarters, but it could well, come in again. So there could be that part which does well, and then all the other ancillary industries associated with, real estate consumption. We've talked about, combination of discretionary, maybe some staples. So all those sectors, etc., should get a leg up. And then, frankly, you know, I think, as I was saying earlier, and I believe that the budget has added, to the India story. We know that consumption is a bit weak. It's tried to kind of address that problem. Infra spend, anyway, the government has done their bit, from 1.7% of GDP. It's been taken up to over 3%. Now it'll grow in line, in line with nominal. And hopefully you get more private capex coming in. So the India story, both on consumption and even the investment side, is intact, notwithstanding whatever concerns might be there. So in which case, then, even the banking sector has to be a part of this whole story. There has been some concerns in recent times on asset quality in some segments, maybe MFI, unsecured and all. But my view is that these are more short term. I don't think there's some deep, asset quality problem across the space. So even the banking sector, should be looking up. Besides and therefore, you have the banks, you have some of the consumer cohorts, etc., real estate. So there are enough sectors which get that additional growth to continue on a on a reasonably good growth path.
Sir, as you rightly mentioned, the consumer sector is there, real estate sector is there, and even financial sector is there, which might get the spur due to this, the concessions given to the budget. But sir, could you just tell us about three sectors? Can you just pick up the three sectors that will benefit the most from this budget, over the next 3 to 5 year period, and which would be then what could be the reason for?
See, I mean, so the one sector I've missed out, and which seems to be, kind of assumed to be a loser in this budget, is the whole capex side of the economy. But I don't think, I mean, to us, even a year ago, it was evident that this whole government-led support to capex and infra, was done, a year and a half ago, and it had to consolidate, etc. And we are in that phase right now. But that doesn't mean that, the capex story has stopped. Of course, each cycle, is different. And this time around also, the capex cycle is different from the earlier cycles. So I would think that, there within the infra and capex, there are segments which will continue to do very well in the next 3-5 years. And there'll be opportunities for investors to participate through, those select sub-segments within capex infra. So, when you think of it, say the power sector, which is not necessarily captured in the infra spend of the government at the budget level, but there is a lot of private sector activity going on there, and participation going on, including in renewables, and also then related to power, the evacuation of power in the T&D segment. You've seen in the budget how the government has given more incentives to state governments to improve on their T&D and all of that, which will require more capex. So there'll be parts within capex. Similarly, we know there's a whole trend underway besides renewables, but also in things like data centers, and the whole ancillary of EVs and all that. I don't think that's reversing. That is going to continue for, for those 3-5 years you're talking about. So one has to kind of be identifying ideas which are plays on some of these segments of the economies which will do well. Of course, some new areas which the government has talked about, but those I will admit are a bit long drawn. There's the whole thing of getting nuclear power up to some, 100 megawatt, if I recollect, but gigawatt, sorry. But yeah, that's over 20 plus years. There could still be plays, already who would have a kind of head start there versus other names in the within the capex infra space. So I think it will be selective, but there will be enough opportunities even within capex, because if India has to grow, to me, these are all sectors which have to participate. The banking sector for the credit, need of the system and the economy, and in fact, there's still scope to do a much better job there. Especially for the people who have unmet credit needs, maybe through the use of technology or whatever. But there's that whole part of the economy which will participate. And then, of course, I would think that consumption and investments as well. Yes, but there are these phases we've been through that where, okay, infra takes the, is, hitting the ball out of the park. I think sometimes there will be a bit of adjustment, but each of them, for an investor with a longer term horizon of 3 to 5 years, should be an integral part of his consideration set, a part of his portfolio. So there it's up to the investor to be doing his own stock picking. But to me, I mean, I think all of them are, secular parts of the India story at this point of time. When I touched on infra, I also had earlier touched on residential. I think that cycle still has some more, years to play out, and therefore it should also be part of, portfolio. So yeah, so to answer your question, the three sectors I would think of, the one is of course the banking and financial services. The other is consumption, maybe a bit more tilted towards discretionary, but really bottom-up ideas there. And then the capex infra theme, I think will also remain valid on a bottom-up basis.
Right now, finally, Gaurav, if you had to give one piece of advice to retail investors who are trying to navigate the equity markets post this budget, what would that be?
See, for retail investors or for any investor, I would say that the first piece of advice would be just be sure of the investment horizons. So ideally, equities is best used as a vehicle for investments if the investment horizon is at least 3-5 years plus, because that's where you get to benefit from the power of compounding. Now I'm speaking more to equity investors. If somebody is trading, then his horizon is of course very short term. He would well be delighting in a market like this or with high volatility. For other investors who have that longer term horizon, uh, this volatility should not, scare or cause concern. Of course, to me, I have huge conviction on the India story, the stability, and whatever policy interventions have happened, including in this budget, have just to me reinforced my belief in the outlook which equities will give to investors, and especially through the power of compounding. Let me reiterate that, because that's rather than trying to time this, just staying the course is can be equally, if not more, beneficial. So I would say don't get too perturbed, because in the background there'll always be some news or something which doesn't meet expectation, and something, some other thing, like we're seeing the global, trade wars might have just started. They will definitely cause more volatility, especially through currency and all of that. But again, I think nothing to be too perturbed about if you have a longer term horizon. Also, at this stage, frankly, when we look at the markets, there are enough cohorts, especially say the large cap, where there is comfort on the valuations as well. So valuations are comfortable, and then there's that structural tailwind and a growth. Um, uh, if one is aligned with companies or industries which demonstrate profitable growth, that should help and go a long way in meeting um, investor objectives. So yeah, I would say that have a longer horizon, patience, and know fully well that equities is a volatile asset class. So be sure of your emotions, and then just stay the course to try to benefit, and benefit from the power of compounding, which the asset class will offer. Yes, there'll be pockets in, say, right now, the small mid for the last couple of months where there was valuation. Those are being reset, and so for investors, if they're investing themselves, then I have not much to say. But if you're doing it through mutual funds, then if you're overexposed to some particular market cap, you could look to realign, or you could be present through flexi caps or multi caps, which give you a bit more broad-based exposure, and the fund manager takes their call on which kind of market caps are looking or are offering the best value proposition. So either of those, but keep the faith, and be invested for the long term. I think the returns will be better than most other alternate asset classes I can think of.
Great. On that note, let's wrap up this discussion. Thank you, Gaurav, for sparing time, and thank you for this interesting discussion. Thanks.
Yeah, thanks, everyone.
Think equity. Think Motilal Oswal. Enduring legacy comes full circle, fueling dreams with trust eternal.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.